Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, January 9th, 2024. Hope everybody's having a good day out there. I had to get up extra early. Had to go get my physical done this morning. First thing with my doctor, go get your yearly checkups, folks. And it was cold. Woo. It was 6 degrees on the way to the office. It was a bit of a drive. I live out in the middle of nowhere, so it took me a while to get there. But it was quite chilly. So it did warm up. I think it's about 34 degrees last time I saw the temperature. But chilly, chilly, chilly. We got more snow on the way. So hopefully it's not nearly as bad as, what was that, Sunday night? So anyways, if it is your first time here watching Liberty Call, I'm glad you're here. And if you could do me a favor, if you could give me some thumbs up, likes, shares, subscribes, follows, press the notification bell because you want to know when I go live. I occasionally say something smart. Occasionally. It's not an everyday thing. All righty. Well, let's go ahead and get into the numbers for today. See how things turned out. Looks like NASDAQ managed to finish in the green. Everything was in the red earlier today. The Dow Jones was down 0.42%, 157 points, closed at 37,525. S&P 500 down 0.17, closed at 47.55. NASDAQ up 0.09, closed at 14,857. The VIX was down 2.6% today. It's at 1274. Canada was down 0.49. Brazil was down 0.76. And Mexico down 1.88%. In Europe, Germany was down 0.17. The UK down 0.13. France down 0.32. The Netherlands down 0.19. Spain down 1.46%. Italy down 0.53%, Switzerland up 0.16%, and Portugal down 0.27%. Russian exchanges split today. The MOEX down 0.1%, RTSI up 1.5%. And the Asian markets, they were green today. That's a bit of a shock. The Nikkei in Japan was up 1.19%, Australia up 0.93%, New Zealand up 1.12%, and China, the Shanghai was up 0.2%, Shenzhen Component up 0.27%. Let's see here. China A50 up 0.18, DJ Shanghai up 0.19, Hang Seng up 0.27, and the Taiwan weighted down 0.21% for the day. So it looks like the Asian markets got in on some gains, probably leftovers from yesterday, because if you remember, yesterday's markets were in the positive. So anyways, all right, let's get to the market recap. S&P 500, Dow slip as yields move higher ahead of data. It's probably the inflation data later this week. All right, let me get my notes, and here we go. All right, on Tuesday, the S&P 500 and Dow Industrials experienced declines influenced by a slight uptick in Treasury yields as investors assess the potential timing and extent of Federal Reserve interest rate cuts in 2024, particularly in light of the upcoming inflation data. And I'd also say in light of the, we covered this article yesterday where they had pulled off, 430,000 jobs or 439,000 jobs off the job boards. That was an overstatement. So that might have something to do with it too. Let's see here. Where were we? Particularly in line. Yeah, okay. Expectations of rate cuts initially strong for March have diminished with the CME's FedWatch tool showing a 63.8% chance of a cut of at least 25 basis points in March, down from 79% a week earlier. Treasury yields have remained close to the 4% mark, with the 10-year U.S. Treasury yield reaching 4.01% after touching a high of 4.053 in the session. Investors are preparing for additional Treasury supply, awaiting inflation data from the Consumer Price Index and the Producer Price Index later this week. Earnings season is set to begin unofficially on Friday with reports from major banks like J.P. Morgan. Concerns about speculation regarding the Fed's actions and potential rate cuts have led to market fluctuations. Most of the major S&P sectors declined, with energy experiencing the most significant drop of nearly 2%. Tech was among the few sectors in positive territory, recording gains of about 0.3%. Atlanta Fed President Raphael Bostic emphasized the importance of maintaining tight monetary policy on Monday, while Fed Governor Michelle Bowman, previously hawkish, signaled openness to supporting rate cuts as inflation eases. One person wants to continue what we're doing, the other wants to go ahead and appease Wall Street and the big banks. You can tell who works for who. Where were we? Oh, yeah. Investors are closely monitoring the perspectives on the policy outlook from Vice Fed Vice Chair for Supervision, Michael Barr, scheduled to speak on Tuesday. Boeing weakened for a second consecutive session, down 1.3%, as the U.S. National Transportation Safety Board continues its investigation into a recent incident. Yeah, it's when the hatch fell off the plane in mid-flight. Not good. Glad everyone had their seatbelts on. Let's see here. In M&A news, Jupiter Networks surged 22.2% following reports of talks with Hewlett-Packard Enterprise for a potential $13 billion acquisition, while the latter saw a 7.3% drop. Declining issues outnumbered advancers on both the New York Stock Exchange and the NASDAQ. So it's kind of a meh again. It's kind of the way things have been for a while. Alrighty, let's get into some nitty-gritty details here. U.S. trade deficit shrinks in November on falling imports. All right, well, a shrinking deficit actually might be pretty good because that actually will help GDP for Q4. All right, where are we? All right, in a unexpected development, the U.S. trade deficit contracted in November as imports of consumer goods reached a one-year low amid a slowdown in domestic demand. The Commerce Department's Census Bureau reported a 2% reduction in the trade deficit to $63.2 billion, contrary to economists' expectations of a rise to $65 billion. The data revealed a 1.9% decline in imports, driven by a drop in consumer goods imports to the lowest level since November of 22. Notably, imports of pharmaceutical preparations, industrial supplies, and materials also experienced declines, while crude oil imports increased. Why do we import oil? I don't understand that. I mean, we have more than enough here in the United States. I don't know why we would. I mean, unless it's a type of crude that we just don't have here domestically. That might be the reason. Exports also fell 1.9%, with industrial supplies and materials witnessing a $3.6 billion drop due to lower oil prices. Motor vehicle parts and engine exports declined, likely influenced by production delays following strikes by the United Auto Workers Union. Despite the decrease in consumer goods exports to the lowest level since December of 22, exports of capital goods reached a record high. The goods trade deficit narrowed by 0.6% to $89.4 billion, and when adjusted for inflation, the real goods trade deficit contracted by 2.7% to $84.8 billion. The November data suggested that trade might have no impact on economic growth in the fourth quarter if the trend persists into December. Economists previously anticipated a small drag on GDP in Q4, but the recent reduction in imports aligns with businesses scaling back inventory accumulation in anticipation of slower demand, aka a recession. The goods trade deficit with China fell by $2.4 billion to $21.5 billion, reflecting a decline in imports, typically for November when businesses complete their holiday shopping orders. The impact of disruptions in the Red Sea on U.S. trade flows is expected to be modest, with potential shipping delays through the Panama Canal posing a greater downside risk. Overall, the trade data suggests weakening growth both domestically and abroad, aligning with concerns about a global economic slowdown amid significant rate increases by central banks worldwide. Well, if these countries didn't want to have to deal with inflation, they probably shouldn't have printed all that money. I mean, I know they've followed the lead of the United States, but I mean, if you don't want to have all that, create a lot of inflation, you don't print a lot of money. I mean, because you just had too much money chasing too few goods, makes prices go up. It is Econ 101 stuff, folks. All right, last up article here from Zero Hedge titled "Buckle Up for a Bumpy 2024. Economists Warn." This was written by Emil Akan from the Epoch Times. All right, let's see what he had to say. In 2023, the U.S. economy navigated a tumultuous path marked by high inflation, surging interest rates, geopolitical conflicts, and a banking sector instability. Initial concerns about an imminent recession were fueled by the banking turmoil in the second quarter, culminating in a 1930s-style bank run on Silicon Valley and First Republic banks. However, swift intervention by the Federal Reserve with emergency measures restored bank liquidity and normalized financial and credit markets. For now. Contrary to recession fears, the U.S. economy exceeded expectations, posting a robust 4.9% growth in the third quarter, driven by strong consumer and government spending. Well, see, there's a problem. Government spending isn't really growth. It's just stealing from me and putting it in the pockets of the defense contractors. As discussions about a potential soft landing in 2024 gain traction, economists remain cautious, anticipating challenges due to the lingering impact of tight monetary policies over the past 2 years. Recession concerns persist, with analysts predicting a significant slowdown in the coming months and some foreseeing an actual recession. Factors contributing to this outlook include a yet-to-be-realized effects of the Federal Reserve's tightening policies and challenges in the commercial real estate space that could trigger another regional banking sector crisis. While inflation has shown signs of easing, concerns linger, and experts predict a bumpy path towards the Federal Reserve's 2% target, not expected until the end of the year. Despite the decline in inflation from the peak of 9.1% in June of 22 to 3.1% in November of 23, consumer experiences vary, with real prices still elevated. Yeah, go to the grocery store. Tell me how cheap everything is now. The labor market experienced notable changes in 2023 with rising salary expectations. However, challenges arise as businesses impacted by higher costs and inflation face pressures on payroll budgets. Analysts anticipate a softening job market in 24, potentially leading to an increase in the unemployment rate. The Federal Reserve remains a focal point with expectations of interest rate cuts in 2024. Uncertainties about the pace, timing, and size of rate adjustments persist, contingent on progress in inflation, particularly in shelter inflation. Speculation about the Fed's role in influencing the 2024 election adds complexity to the economic landscape. Yeah, you don't want to do anything bad that could get, old Joe out of office, because that would just be terrible. I mean, granted, the alternative of Cheeto Boy, I personally would just blow up the entire system and just, get rid of the federal government, let the states run everything. I mean, there'd be a lot less war in this world, and probably the people around the globe would be happier about that. All right. Persistently high interest rates are expected to endure, with a consensus that rates will settle lower than current levels, but higher than the net zero rate seen in 2008 financial crisis. The impact of elevated interest rates on credit card, home equity, and auto loans is evident, influencing consumer behavior and the real estate market. The stock market experienced a Santa Claus rally in 23, with significant gains driven by expectations of future interest rate cuts. However, the new year saw a decline in major indexes, with uncertainties about inflation and the likelihood of rate cuts contributing to market volatility. Analysts anticipate a bumpy ride in 24, with considerations for potential election-related fluctuations and a shift towards value, dividend, and small cap stocks after the strong performance of high growth stocks in the previous year. All right. So that's so according to economists, or at least some of them, we're going to have a rough ride, which I think I've been saying that for a while. At some point, there's going to be that black swan that flies through and creates a, chaos in the financial system. And, we'll just have to deal with it. But, until that time happens, make sure you're prepared. That's all I can really tell folks is prepare for that hurricane that, will come ashore at some point. Make sure you got all your batteries and your, your food and bread and all that good stuff. Same thing with your finances, making sure you've got a nice bit of sandbags around your position so that you don't get kicked in the balls too hard, because that's not a lot of fun. All right. Well, that's everything I had for today. If anyone needs anything from me, like getting your finances in order, go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you again next time. Adios.